Greetings to all, and here is what lies ahead, providing you with the knowledge you require to more effectively traverse these challenging times. Discuss cancel culture. The gold standard, which the United States successfully implemented from George Washington's time until the early 1970s, has long been the great unmentionable among economists and financial officials who categorically reject even a discussion of the subject. This is unfortunate because the gold standard's existence would have spared us the financial crisis of 2008 to 2009, the unprecedented interest rate suppression that followed, and the massive money printing that took place prior to and throughout the pandemic. All of this contributed to the current state of chaos. Money is a measure of worth, just as scales, weight boxes, timers, and rulers are, and we are all naturally aware of the necessity of set weights and measures in the marketplace. An economy functions best when its currency is a reliable measure of value for a variety of reasons. For example, the size of a gallon, the number of ounces in a pound, the number of inches in a foot, or the number of minutes in an hour do not change daily. Gold, on the other hand, has maintained its intrinsic value better than anything else for thousands of years, longer than silver, platinum, palladium, copper, coconut shells, or cryptocurrencies. Just as fixed weights in the grocery store make it easier to shop, a pint of ice cream today is the same size as it was yesterday. Similarly, money that is fixed in value makes buying, selling, and investing easier. When you see the price of gold fluctuate, it's not the gold's value that changes, but the value of the currency it's being priced in. All that would happen if we went back to a gold standard and fixed the dollar to the yellow metal at, say, $2,200 an ounce, is that the money supply would be increased if gold fell below $2,200 and decreased if it rose over $2,200 contrary to popular belief. A gold standard only ensures that newly minted money has a steady value rather than artificially limiting the amount of money available in an economy. The globe never returned to the post-Globe War II gold standard, and as a result, we have suffered from an average economic growth rate that is far lower than our historical norm. The United States destroyed the gold standard without really meaning to do so in the early 1970s. Think about this. From the late 1970s, when we were beginning to recover from the distortions caused by the Second World War, our average growth rate was approximately 4.2% until we abandoned the gold standard. From that point until the pandemic, the average growth rate was approximately 2.7%. Had we maintained our gold-based average, our median household income would have been approximately $100,000 higher than it is today, minus $70,000 to $40,000 more. In the United States, we witness a slow and agonizing decline of the U.S. dollar precisely because the global majority is not exactly sure that they like what they're observing in terms of foreign policy and economic sanctions, which is why we see them to dollarize. Slowly but surely, people begin to realize that fiat currencies are worth absolutely nothing. The conversation then shifts to what can be done to restore value and trust in our currency. The Federal Reserve Bank of Philadelphia's researchers recently declared that going back to the gold standard would be a good idea and a way out. They think it would help stabilize prices, and that going back to the gold standard would mean that inflation and deflation would only be transient phenomena. Before I go into further detail about the federal government's research, let me quote Judy Shelton, a former White House economic advisor, who expressed her support for going back to the gold standard. She said, "I like the idea of a gold standard. I mean, it could be used in a very cryptocurrency way. The key is to have a single money system so that, in the global economy, everyone operates on an even playing field in terms of money. Therefore, it is evident that everyone recognizes that the U.S. dollar is drawing closer to the end of its useful life, and that there may not be much that can be done to save it because everything that could be done to turn the tide is opposed by those who make decisions on Capitol Hill, making a national gold standard adoption unlikely. In order to return to the gold standard, a quiet, dramatic event akin as a crash or crisis would need to occur. Perhaps using blockchain technology, XRP could serve as the link or bridge for assets backed by gold. Having said that, let's get back to the recent research that the Federal Reserve Bank of Philadelphia released. There are a few very important details that I would like to share with you. I know that the research paper has already garnered a lot of attention, and some people have misinterpreted it to mean that the Federal Reserve will begin reverting to the gold standard or that they will seriously consider it. However, you should read the research paper and draw your own conclusions. It was published in February 2024. In summary, the Federal Reserve informs us that if our currency is backed by gold, we will not experience any loss of value in our dollars over time. There may be a slight variation in its value, but that would be driven by a variety of factors that would absolutely have no long-term effect. For example, your savings would never be subject to inflation. The gold standard ensures long-run price stability. The price level in the home country consistently converges to its long-run equilibrium value. Inflation and deflation thus become temporary phenomena. Wouldn't that be incredible? The Fed's second point is that under the gold standard, money is not neutral. This means that when the amount of money in the home country falls below the level of the steady state, the home country temporarily accumulates gold along the transition path, which is how the money supply rises over time. In other words, when the amount of money in the country drops, new money can only enter the country if exporters bring in more gold than importers take out. You would agree that this is a far cry from the current situation, in which the Federal Reserve may essentially print money out of thin air, in which value is produced in this manner. Thirdly, because of the inelasticity of the money supply, the home country is susceptible to external shocks. I will elaborate on this point regarding the money supply under the gold standard in a moment. If money is backed by gold, a decline in the money supply would be associated with a decrease in output and subsequently fall in prices in that country. I realize this may sound quite complicated, but to put it simply, elastic money supply refers to a static money supply that remains constant. It describes both the advantages and disadvantages of having gold-backed currency. Trade disruptions, policy changes, and even the financial crisis may be the source of external shocks. Sanctions implemented by other nations restricting export and import transactions may also be the source of external shocks. Thus, these factors would make it difficult to obtain more gold, which would in turn restrict the amount of money available. Keep this in mind when someone suggests that we should go back to the gold standard. There would undoubtedly be enormous advantages, but there would also be drawbacks, one of which would be that the U.S. would have to give up its love of economic sanctions. The Federal Reserve concluded that there would be very little choice for policymakers. For instance, the paper states that the options available to policymakers under the international monetary system based on gold are more constrained than those under a fiat money system when it comes to economic penalties. The domestic government is unable to alter the amount of money in the nation without going against the fundamental principles of the gold standard. In actuality, this is one of the primary arguments against the idea of converting to gold-backed assets from our current uniparty. Eliminating fiat money would require the U.S. to become an extremely skilled international corporation rather than viewing other nations as inferior entities. Therefore, even while going back to the gold standard might benefit American consumers in the long run in terms of price stability, it would present significant political obstacles to the current system. So much need and desire still the Federal Reserve's research and writing of a comprehensive 50-page white paper, in my opinion, indicates that we urgently need a way out of the economic downward spiral we are in. In particular, the U.S. wants to ensure that the dollar remains the world reserve currency, and that the U.S. as a nation does not relinquish its position as the world's hegemon, the part that has escaped its grasp as the globe rapidly shifts and becomes more divided. In conclusion, while the suggestion to return to the gold standard as a means to lower inflation carries weight and historical precedence, it's crucial to recognize the complexities and potential drawbacks involved in such a transition. The Federal Reserve's acknowledgement of this proposal underscores the gravity of the current economic situation and the importance of exploring all avenues to stabilize inflation. As investors, it's imperative to stay informed, adapt to changing economic landscapes, and consider a diverse range of strategies to navigate market fluctuations successfully. Like, share, and subscribe to stay updated on the latest insights and analysis from Investing Tutorial as we continue to explore key topics shaping the world of finance and investment.